Over the past 15 years, the landscape of U.S. energy production has undergone a dramatic transformation. From a nation heavily reliant on energy imports, the United States has shifted gears to become a powerhouse in energy production, boasting significant increases in oil exports, natural gas production, and renewable energy generation. This seismic shift holds profound implications, not only for the nation's energy sector but also for investors looking to capitalize on this evolving landscape. In this video, we'll explore the remarkable surge in U.S. energy production and its consequences for investors. Big shout out to Seeking Alpha for sponsoring our video and its analytics. Make sure to get your 14-day free trial of Seeking Alpha Premium via the link in the description. You can only get the 14-day trial through the link below, so make sure to check them out, guys. The energy production boom. The numbers speak for themselves. Between 2007 and 2022, U.S. energy production has seen staggering growth across various sectors. Oil production has surged from 6.86 million barrels per day in 2007 to a whopping 17.79 million barrels per day in 2022, marking a remarkable 159% increase. Natural gas. The U.S. has increased its natural gas production by more than 50%, with a rise from 24.66 trillion cubic feet per year in 2007 to 43.39 trillion cubic feet per year in 2022, representing a 76% increase. Renewables. Solar and wind energy have experienced exponential growth. Wind production has skyrocketed from 341 trillion BTUs per year in 2007, 845 trillion BTUs per year in 2022, an astonishing 1,027% increase. Solar energy production has followed the suit, surging from 65 trillion BTUs per year to 870 trillion BTUs per year during the same period, a staggering 2,777% increase. Coal. While coal production has seen a significant decline, dropping from 147 million tons per year in 2007 to 594 million tons per year in 2022, the overall increase in other energy sources has more than compensated for this decrease. Not driven by demand. One of the most striking aspects of this energy production boom is that it hasn't been fueled by surging energy demand. Over the same 15-year period, annual energy consumption in the United States has remained relatively stable, with a slight decrease from 100.9 quadrillion BTUs to 100.3 quadrillion BTUs. This signifies a decoupling of production from demand, indicating that the U.S. has not only achieved energy self-sufficiency, but has become a net exporter of petroleum, natural gas, and coal. Implications for investors. What does this massive increase in energy production mean for investors? It suggests a wealth of opportunities, particularly in the energy sector. Investors have already started reaping the benefits, with a notable uptick in merger and acquisition activities within the sector. Companies like Magellan Midstream Partners, MMP, and Crestwood Equity Partners, CEQP, have been acquired, demonstrating the attractiveness of energy-related investments. As the U.S. continues its journey from an energy consumer to a net producer, more investment opportunities are likely to emerge. In subsequent articles in this series, we will delve deeper into the specific effects of this energy production surge, including its impact on natural gas, oil, and renewables. Stay tuned for these in-depth analyses. In the not-so-distant past, the U.S. faced a daunting challenge: a hefty trade deficit exacerbated by the soaring costs of oil imports. The days of importing more than 10 million barrels of oil per day meant a potential annual trade deficit exceeding $700 billion. Such imbalances had the potential to disrupt exchange rates, shake confidence in the American economy, and even stifle economic growth. As we approached the panic of 2008, oil prices briefly flirted with $145 a barrel, and some experts predicted they could reach as high as $200 a barrel. This looming threat cast a shadow over the nation's financial stability. Let's rewind to 2007, when massive US oil imports were driving up the trade deficit. The surge in oil prices leading up to the panic of 2008 saw oil briefly touch $145 a barrel, with some experts even predicting it could hit $200. When you're importing over 10 million barrels daily, a $200 barrel spells a staggering $700 billion annual trade deficit. This imbalance had the potential to disrupt exchange rates, erode confidence in the economy, and stifle growth. Debates have raged over the impact of rising oil prices on the economy. Some economists argue that surging oil prices act as a choke chain on economic growth. This chain reaction starts with economic growth leading to increased oil demand, resulting in higher prices, inflation, and ultimately compelling the Federal Reserve to hike interest rates, triggering a recession. Historically, recessions in 1973, 1979, 1990, and 2008 appeared to coincide with sharp oil price increases. Higher fuel costs have a tangible effect on middle and lower middle-income Americans, siphoning money from their wallets. The panic of 2008, primarily fueled by the housing market collapse, saw an unexpected spike in oil prices. This sudden increase in gasoline prices disproportionately impacted middle-class Americans, exacerbating the mortgage crisis. Fast forward to today, and the U.S. energy scene has transformed dramatically. No longer heavily reliant on oil imports, the U.S. is now a significant global energy player. While we remain vulnerable to world oil price fluctuations, there's a key difference. In 2007, the money spent on pricey imported oil left the country, offering little economic benefit. Today, if oil prices surge, the money stays within the U.S. economy, bolstering royalty payments, tax revenues in oil-producing regions, increased investments by oil companies, and higher dividends for U.S. oil company shareholders. This immediate reinvestment of funds within the U.S. economy could help cushion the adverse effects of rising oil prices on growth and reduce the risk of a severe recession. This factor, among others, may explain the surprising resilience of the current U.S. economy. Energy independence enhances national security. In the 20th century, oil played a pivotal role in the causes and outcomes of major conflicts, including World War II. Today, oil independence gives the U.S. more leverage when dealing with oil-exporting nations, including Russia. The Strategic Petroleum Reserve, originally established to secure military oil access during import cutoffs, now serves to stabilize markets and generate profits through strategic buying and selling, a policy the Biden administration seems to endorse. While the petroleum market remains complex, the U.S. should take measures to protect itself against sudden import disruptions. It's worth noting that many U.S. allies still rely on oil imports, and the U.S. would likely step in to help mitigate disruptions by increasing exports. However, the impact of an import disruption on national security today would be far less severe than in 2007. From an investment perspective, these shifts hold significant implications. The U.S. becomes an attractive destination compared to markets vulnerable to oil price shocks. A robust dollar further enhances the appeal of dollar-denominated assets. The U.S. energy sector takes center stage as a source of exports to allies, particularly natural gas-focused companies such as Antero Midstream, AM, with a yield of 7.6%, Cheniere Energy, LNG at 1%, and Enterprise Products Partners, EPD, with a yield of 7.4% warrant investor attention. The surge in U.S. energy production has reshaped the nation's economic landscape and fortified national security. For investors, this new era offers a wealth of opportunities, with the U.S. energy sector and dollar-denominated assets standing out. As the world adjusts to these changes, savvy investors can position themselves to thrive in this dynamic environment, where energy self-sufficiency has replaced reliance on imports, and new investment horizons beckon.